Okay, I have calculated the balances for each of the T accounts, and I have indicated the balance at the bottom left side for the debit accounts, and on the bottom right side for the credit accounts. And I think it's important to note, even though the textbook doesn't really discuss it at this point in time, that the next step would be to prepare a trial balance. And a trial balance is simply a report. It's not a financial statement. A trial balance is a report that shows each account balance either as a debit or as a credit. Debit's on the left side, credit's on the right side. We would list all of the accounts with balances. Show your debits on the left side in one column, your credits on the right side in another column. And if you were to total your two columns, your debit column and your credit column, they should be equal. So as long as they are, we would say our trial balance is in balance, we're okay, and we can proceed with the next step, which would be to prepare our financial statements. Now in this case, we're only working with the balance sheet. We have no revenue accounts, no expense accounts, none of those types of transactions. And so the only financial statement we are preparing in this problem is our balance sheet. And we simply, maybe I shouldn't say simply, but the way we do our balance sheet is to take each balance in each of our accounts and show them on our balance sheet. Keep it in mind, our balance sheet is going to show us our assets, our liabilities, and our owner's equity. So we can go to the next page here, and our company name is always at the top. Deliberate Speed Corporation. Again, we should never abbreviate on our financial statements, but I'm going to abbreviate there. And this is our balance sheet. And the date of this balance sheet is July 31. So we started with our June 30th balances in several accounts, which became our July 1 balances. We journalized by analyzing and classifying. We journalized 5 transactions for the month of July, and then we summarized our T accounts and got the balances for each T account that we are using at July 31. And so our balance sheet is as of July 31. Our format is always important. We have assets at the top, and we list our assets in order of liquidity, most liquid to least liquid. Liquidity refers to the ability to be turned into cash. So cash is always listed first, and you work your way down from cash in terms of liquidity. Typically you would have cash listed first, accounts receivable, which is turned into cash when they are collected, listed next. And then current asset items like supplies and inventories will be listed next. And then less current assets or long-term assets like equipment and buildings and land will be listed towards the end. So our cash balance is $234,000. supplies is $37,000. Now our next three asset accounts are all non-current or long-term, and so I believe this should be a classified balance sheet, which means we need to show current assets as a separate total. So we get a total for our current assets. $271,000. And then we add our equipment and factory building and land in that order, again based on liquidity. Equipment balance is $318. The factory building account balance is $282,000. And finally, our land account balance is $200,000. At that point, we want our total assets. Let's see if I can do this by hand here. 8 and 2 are 10 and 11. 7, 8, and 8, 16, 17. And 3 and 3 is 6, 7, 8, 9, 10. $1,071,000. That's correct. So we have our assets shown first, followed by our liabilities. And shareholder equity. We have two liabilities: accounts payable at $40,000, notes payable at $192,000. And we want to show our total liabilities. It's going to be a tight squeeze here on the bottom. $232,000, followed by our equity accounts. We have two equity accounts. Contributed capital at $580,000 and retained earnings at $259,000. Contributed capital and retained earnings. Again, contributed capital is capital or equity contributed by the owners of the business. Retained earnings is the accumulation of net incomes and profits over time. Retained earnings represents internally generated capital. And again, our retained earnings balance from the T account is $259. So then we get our total shareholder equity amount. It's going to be a tight squeeze on the bottom here. This is going to be $839, and then we add our liability total and our equity total. Liability total, equity total, to get our total liabilities plus shareholders' equity. And I'm going to use my calculator for that one. And that is 232 plus 839. And what do we want it to equal? Our total is $1,071,000. Total liabilities plus shareholders' equity, which again are equal. I'm sorry, total liabilities and shareholders' equity is equal to total assets. That's what we want to see. We're in balance. The last part of this problem, requirement 5, as of July 31, has the financing for DSC's investment in assets primarily come from liabilities or equity. Again, we go back to the beginning of the chapter on page 47. It has a brief explanation of financing activities. Assets are financed with either debt or equity. And when we look at debt with respect to financing activities, we're looking at long-term debt. What makes a liability long-term versus not long-term or current? Well, the magic time period is 1 year. If we expect a liability to be paid off in a period of a year or less, and that liability is considered current. If we expect a liability to be paid off in periods exceeding 1 year, then that liability is considered long-term. So in this example, our note payable total is considered long-term. So if we look at notes payable of $192,000 and compare it to equity of $839,000, it becomes obvious that our assets are financed primarily through stockholders' equity. You can either borrow to finance asset acquisition, or you can generate capital or generate equity, again, externally by selling stock to owners or potential owners, or through internally generated capital, retained earnings, which is the accumulation of net incomes and net losses over time. So if you have a profitable company, generating profits, your retained earnings will grow over time, and that will add to your equity base for your business. I think that sums it up for this problem. I hope it's been helpful, and thanks for your attention.